Hey everyone, thank you for joining today's webinar. MedHQ is the leader in back office services for surgery centers. During the COVID-19 crisis, they have been answering many questions related to HR and accounting and want to share their expertise with the industry. Today, they will be going over the most recent bill that was passed and walking through a PPP Loan Forgiveness application. With that, I would like to introduce Tom Jacobs, CEO, and Dave Becker, Vice President of Client Account Services. Tom and Dave, take it away.
Thank you, Lindsay. Hello, everybody. This is Tom, and on behalf of Dave and myself, thank you for joining us for our call today. This webinar is a little different than the previous four that we've done since the COVID outbreak. We've been doing a Q&A format, and we still want to answer all your questions, but this time we're going to use a little bit more traditional presentation approach, then answer questions as best we can, probably toward the end of the session. With that, I must say, I don't think any of us in our wildest dreams thought, 4 months ago that the federal government would be handing out loans to businesses, basically with minimal loan covenants, and then add to that an ability for the entire loan to be forgiven, and then add to that repeated efforts to make the loan forgiveness easier and easier. But here we are, and that's really the essence of the PPP Flexibility Act, is that it's meant to make loan forgiveness easier than it would have been under the original CARES Act rules. So we're embarking on this webinar without complete clarity with regard to the rules and how they're going to apply, but we know that many surgery centers are completing their 8-week covered period, if that's what they choose. We'll get into that in a second. But given the timing, we felt it worthwhile, even though we don't have all the answers, to do this presentation and hopefully help people in surgery centers best determine their next steps. So we're an accounting and HR company, so we're not lawyers. We're not a public accounting firm. We do have CPAs on staff, but we do management accounting and bookkeeping on the accounting side. So please know that this is our approach, but it's not legal or public accounting type advice. As I mentioned, there are a lot of unanswered questions. Please submit questions as we go through here and through the application, and we'll get to them as best we can. So the agenda is to give an overview of the Flexibility Act, then go into pretty detailed but overview of the loan forgiveness process. What should we do first, second, and third, et cetera. We'll talk about some use of spreadsheets and calculations. Anybody that loves doing taxes is just going to love this process. Right, Dave? Yeah. We'll talk about what payroll reports you need to gather, and it's a lot of the same information over and over again, but there are over a half dozen types of reports or runs that you'll need to do and collect in order to prepare the application. And then we'll talk a little bit again about items we think need further guidance, and then answer some questions. So PPP Flexibility Act. If your surgery center, first off, if your surgery center already has a loan, which I know many of you do, then you have an option. Your option is to go with the CARES Act 8-week covered period, or do a 24-week covered period. That period starts on or about the date you get your funds, and goes 8 weeks or 24 weeks after that, and we'll get into that decision in a second. If you don't yet have a loan, the deadline for applying remains June 30th. New borrowers will automatically have a 24-week covered period. The CARES Act objectives are to incentivize returning to normal FTE and wage rate levels. If you don't achieve the prior levels before COVID, before the shutdown, then there are potential reductions to your loan forgiveness. However, there are a couple key safe harbors, and we'll talk about those. Lastly, at least 60% of PPP loan funds must be used for payroll instead of the previous 75%. So there's more flexibility there. For surgery centers in particular, we know many places are still at least in a partial shutdown mode, so it may have been difficult to bring back your staff to previous levels, so this additional flexibility should help. But again, if you can't reach the 60% threshold, that is payroll costs being 60% of your use of the funds at least, then if you don't get 60%, you could still have some loan forgiveness. It's sort of prorated, okay? All right, Dave, you want to?
So the PPP Flexibility Act, Loan Forgiveness, Safe Harbors. Opportunity to avoid FTE reduction penalties if headcount is restored by December 31 instead of June 30. If your ASC reduced staff at some point between February 15th and April 26th due to COVID, and have been unable to bring your case volumes back to the normal level and therefore unable to return to the FTE level in the pay period that includes February 15, you now have more time to reach the February 15 pay period level. At this point, it is unclear if the borrower can claim the safe harbor was met prior to December 31, additional guidance forthcoming or is needed.
And we're expecting that guidance from combination Small Business Administration or Department of Treasury or IRS, right, Dave?
That's right. New exceptions for FTE reduction provided if the ASC can document an inability to rehire individuals who are employees at the surgery center on February 15 and hire similarly qualified employees for unfilled positions on or before December 31, 2020. The second clause may be a bit difficult for some ASCs to prove. Return to the same level of business activity by December 31 as it was before February 15, 2020 due to compliance with requirements established or guidance issued related to COVID-19. This third clause may help ASCs that are in geographical areas that continue to be under government restrictions.
So the PPP Flexibility Act, as mentioned, new borrowers have until June 30th to apply. And instead of the original CARES Act guidance of 2-year loan terms, they will have a repayment period of 5 years. In addition, current borrowers who have loan documents already received their loans, can go to their bank and try to renegotiate their loan to get the 5-year term as well. But you really need to look at your loan documents, start there. That is going to be what determines your payback time period. But the law now allows that you can go to your bank and ask for that to be renegotiated. PPP loan forgiveness no longer disqualifies surgery centers from payroll tax deferral. That was one of the provisions of the CARES Act, is that if you applied and received loan forgiveness, then you're out of luck on the other provision that was meant to help cash flow for businesses, which is the deferral of the Social Security tax. Doesn't mean you don't have to pay the tax, it means it's just deferred. Tax that would have been accrued and paid or due, through the end of this year, 12/31, can now be deferred, 50% of it through will be paid and will be due on at the end of 2021. The other 50% will be due at the end of 2022. Loan payments are deferred until SBA determines the amount of loan forgiveness and remits to the lender. So there's a 10-month period for applying for loan forgiveness, and if you don't have a loan forgiveness decision by that point, there likely will be loan payments due at that point. Next slide. So where does that leave us? Right now, in addition to some of the things you've already mentioned about questions we have, it's not clear. There's not a lot of guidance on tax deductibility of expenses paid with a forgiven PPP loan. I'm going to save the gap one for the end of this list, Dave, because I think we have some interesting thoughts on that. But can a current borrower use June 30th for one of the safe harbors instead of December 31st? We don't know yet. Same with the salary and hourly wage reduction calculation in safe harbor. Don't know yet whether that's a December 31st strictly, or if there's some earlier time frame like June 30th that can be done. And lastly, the $100,000 compensation for individuals that earn at that level or higher. There's quite a bit of mention in the forms and the guidance about specific $15,000 and some dollars dollar amount that is used in the calculations. It's not clear whether now that is 24 50-seconds or if it remains 8 50-seconds based upon the longer covered period. So GAAP accounting. What's interesting is it seems like, Dave, this change in law, if the loan documents play out and all that stuff, it does give some additional balance sheet help to surgery centers that may have other loans with their bank and covenants, et cetera. Can you talk about that?
So initially, in general, what we have seen is that we set up this loan, the PPP loan, as a current liability. So now with the new Flexibility Act, in that you're able to extend the coverage period 24 weeks, and the payments don't begin until a point in time that could be more than a year. So now the current liabilities actually should be set up as a long-term liability. And, you know, with bank covenants, that does affect your working capital. It provides a little flexibility on, items that you want to pay out that could be, restricted under bank covenants. So that could be a nice help to the center. The other thing on the GAAP accounting here, that more than likely what's going to happen is that when we determine what the loan forgiveness amount is, that will be, now that a liability is not going to need to be paid, that'll be booked as income, but it'll be income below the EBITDA line.
Thank you, Dave. So into the PPP loan forgiveness application itself. First thing you want to look at is your covered period. You basically have one covered period for non-payroll items, but you have an option for payroll cost. The standard covered period is, as mentioned, 8 weeks or 24 weeks after the loan disbursement. The alternate payroll covered period is the period that begins on the first day of the first pay period following the loan disbursement date. And then again, 8 weeks or 24 weeks if you already have a loan. If you're a new borrower, it'd be 24 weeks. So here's an example. Your surgery center receives its funds on Monday, April 20th. The last day of your covered period then, standard covered period, if you have an 8-week, if you choose an 8-week option, the last day of your covered period is Saturday, June 14th. An alternate payroll covered period would be the first day of the pay period following the disbursement. And let's just say you're in the middle of the pay period and that happens to be the beginning of the next pay period is Sunday, April 26th. Then the last day of your alternate payroll covered period is Saturday, June 20th. Again, this applies only to payroll costs and does not change your covered period for non-payroll costs. So one thing to bear in mind here is we don't really address this matter elsewhere in the presentation, so I'll say it now. Your payroll costs during your covered period or your alternate payroll covered period are paid or incurred. So if you pay a pay period that happened before your covered period starts, but you pay that payroll within the covered period, you can do that, and you can take credit for incurring payroll cost for the 8-week period. Okay? I guess we do cover that one more time, and we'll talk about that again after we walk through everything.
Second, calculate your non-payroll costs. Must be paid during the covered period or incurred during the covered period and paid on or before the next regular billing date, even if the billing date is after the last day of the covered period. So if we pay that bill after the last day of the covered period, as long as it was incurred during that period, that would be, you could add that. That would be included. Types, business mortgage interest on real or personal property, business rent or lease payments for real and personal property. And when we talk about lease payments, we're referring to the operating lease variety.
And the space, right, the building.
That's right. And then, you know, if we're looking at like a capital lease, you could do the interest portion, but you would not be able to include the principal portion on any lease, capital lease. Transportation, in bold, not in bold, but in highlighted, we have no known example of what this might be. Tom, did you want to make a comment on that?
We've heard other accountants and people talk about this, and a lot of people are scratching their heads. Maybe it means like a distribution business that has transportation costs, gas, et cetera, for their vehicles. Maybe that's what it means, but probably does not apply to surgery centers.
That would make sense. Other costs, utilities, electricity, gas, water, phone, internet.
Right. Okay, third, we're starting to get fun. Starting to become fun now. Third, complete the FTE calculations for the chosen covered period or the alternate payroll covered period. First, we'll tabulate the number of hours paid in your covered period or alternate period for each week for each employee. Okay, it's very specific. Each week, each employee. Determine the average number of hours paid each week. Hours paid. Not worked, but paid. So PTO, sick leave, etc. However, not emergency paid leave under the FFCRA, but pretty much all other types of pay each week and hours paid each week. Okay, divide by 40. When you get that for each person, each employee, divide by 40 hours for each employee, to get your FTE for each employee each week. Employees that worked more than 40 hours in a period, 45, 50 hours that week, they're capped at 1.0. You don't go over 1.0 for any week. So then you add up all those FTEs per employee per week, or in total. Hours paid each week. I'm sorry, average hours paid each week. So you're going to have an average FTE per employee. You sum those average FTEs per employee, and that gives you a total FTE. Total FTEs, right? There is a simplified method that all 40 hours or more per week are 1.0, and all less than 40 hours are 0.5. When I first saw this, I thought maybe that seems like it's penalizing businesses like surgery centers who have a lot of employees who work, let's say, 32, 36, 38 hours. That's less than 40. They would be, under the simplified method, 0.5s. But it might be a help, and that's because really this is just used for comparison purposes, comparing your covered period to some previous reference period, and we'll get into that in a second. So be careful with this, but it may be a nice simplification for everybody.
Fourth, choose your reference period and calculate FTEs. You are allowed to select the period you use as a reference. So you got two options here. You got February 15, 2019 through June 30, 2019, or January 1, 2020 to February 29, 2020. The idea here is to pick the reference period with the fewer FTEs. That will help to maximize your loan forgiveness. If you're starting at a higher point of FTEs, it's going to be harder to get back to that point later, whenever your coverage period ends or the point where you're going to be comparing. So you want to look at those two periods, see where you land, pick the one with the fewer FTEs. Divide your covered period FTEs by your reference period FTEs. This will be your reference, your FTE reduction quotient, line 7 of the PPP Loan Forgiveness calculation form. If your FTE reduction quotient is less than 1, you might consider using the FTE safe harbor. If you want to use a safe harbor, there's a few periods you're going to have to calculate the FTEs, and they're listed here. You calculate for the period that includes 215. You calculate for the period that includes 215 through 426. And you also calculate the period for pay period endings 12/31/2020.
Okay, FTE safe harbor, or reduction and safe harbor. So you're eligible for a safe harbor if you return your staffing level to the February 15, 2020 staffing level. Under the Flexibility Act, it is a little unclear still whether an ASC could use June 30th still. Let's say they choose the 8-week coverage period. Or if for the purposes of the safe harbor, they have to wait until December 31st. So please note, applying the safe harbor will delay your loan forgiveness application to after June 30th, maybe, or possibly until after December 31st, depending upon whether you opt for that 8-week coverage period or a 24-week coverage period. So here are the initial conditions also you must meet in order to qualify for the safe harbor. So if your FTEs between February 15th and April 26, 2020 are less than your FTEs at the February 15th pay period, i.e. that is you reduced staff because of COVID, okay? If you actually did reduce staff, and your FTEs at 12/31 are equal to or greater than your February 15th FTEs, you are exempt from reduction of your loan forgiveness based on this FTE employee level criterion. So it's a little bit murky area still, and we're expecting further guidance, especially whether it can be applied before December 31st or not, but that's where it stands right now. Dave, you want to talk about spreadsheets?
Fifth, prepare labor cost calculations. Don't attempt payroll cost calculations without a spreadsheet. There are a lot, and they're significant. You just need to have a worksheet where you can calculate them efficiently. Now, the AICPA does have a publicly available Excel workbook, so might be a good idea to download that, and you can see, all the different parts to the workbook and how it's going to work. So initially what we're going to do is we're going to run payroll reports for the comparison period. The comparison period is going to be the first quarter of 2020. Then we run our payroll reports for the covered period or the alternate covered period, depending on what we choose. Now, the covered period reports, line item B, will be used to calculate the labor cost, which is a key part of the loan forgiveness calculation. These two sets of data will be compared in various ways in the following slides to assess the amount of any decrease in compensation per employee.
Okay, speaking of changes to pay rates, that's the sixth step here. We're going to analyze any pay rate reductions that may have occurred due to COVID, okay? There's a potential pay rate reduction penalty applicable to each employee paid less than $100,000 per year. So people paid more than $100,000 per year in 2019, they're not part of this analysis, okay? And we'll get into the details of that specific thing in a second, but so we're analyzing pay rate reductions for staff that were paid less than $100,000. So complete your first spreadsheet by tabulating payroll cost for each employee that's on your payrolls during the applicable periods. Those two that Dave mentioned, the covered period and the comparison period. We're going to include in this analysis those employees at any point during the covered period or altered that were employed at any period that we're looking at, okay? Any point in the periods we're looking at. The covered period and the comparison period. And we're going to look at employees that received compensation at an annualized rate less than or equal to $100,000 of wage for all pay periods in 2019. That's how it's worded on the application, all pay periods in 2019. Or even those not employed in 2019 but hired in 2020. Okay, so in other words, everybody that's in your citizenship from the beginning of 2019 through now, or through the end of your covered period. All right, so if an employee, on the other hand, if an employee received a pay increase to more than $100,000 in annual pay rate on or before December 31, 2019, they are not in this analysis. So if somebody even for one day in 2019 was getting paid at a rate greater than $100,000, they're not in this analysis, all right? Just to be real particular about it. All right, wages includes gross salaries, gross wages, tips, commissions, bonuses, paid leave, except for the FFCRA paid leave, and any allowances for dismissal or separation also, so severance pay. For hourly paid workers, we need to tabulate hours paid during the covered period and during the comparison period, and divide those numbers into the actual amount paid during each of those periods to get your dollars paid per hour for each person, let's say if it's for the hourly people, or annual pay rate for salaried people.
That's right.
By employee, compare annual salary or hourly rate of pay for each employee. If all rates of pay during the covered period are at least 75% of the comparison period, there is no loan forgiveness reduction due to salary hourly pay rate changes. So as long as everybody maintained a pay rate at least 75% of what it was pre-COVID, there's no loan forgiveness reduction, sorry.
Salary hourly pay rate reduction. For any employee whose rate of pay was reduced by more than 25%, for each of those employees, calculate the dollar amount of pay reduction that will subtract from the PPP loan forgiveness. So there's a couple steps here. You first calculate the difference in percentage, the actual percentage difference minus the 25%, which is the threshold. So let's say it did go down by 40%, subtract the 25%, you come up with a difference of 15%. You take that 15% and you multiply it by the wages of the comparison period to get your total of the dollar amounts for each employee whose pay was reduced. That's going to end up being your salary, wage, pay rate reduction. But wait, you may qualify for the salary, wage, pay rate reduction safe harbor. Next slide.
You're doing such a great job.
Stop. Salary, wage, pay rate reduction safe harbor. If you have reduced pay rates during the period between 2/15 and 4/26, but restored wage levels by December 31, 2020, the surgery center may be eligible for elimination of salary, wage, pay rate reduction amount. For each employee, what you're going to do is tabulate the rate of pay as of February 15th. And you tabulate the rate of pay as of December 31. If B is greater than or equal to A for all of these employees, then there is a zero pay rate reduction for each applicable employee, i.e., the pay rate reduction amount entered per the previous slide is zero for those employees.
So again, it's an employee by employee analysis. If you have one employee that did not come back to their pay level, you may have some reduction for that one employee, but nobody else. And again, it's only employees earning less than $100,000 that is in this analysis. Oh, there it is. Employees who earn more than $100,000 in any period in 2019 are excluded from the salary reduction calculation. So these are the amounts per pay period, whatever pay period you're on. Labor costs for employees who earn more than $100,000 per year. So let me back up a step. We've previously calculated our total payroll cost with using spreadsheets. AICPA has a very good one, but we only did that so far for people who earned under $100,000 in 2019. So now, and then we did some analysis and some safe harbors and such for those folks. We need to add in the payroll cost for people who made over $100,000. So it's calculated on the same basis as those other employees. So same definition of wage and payroll cost, labor cost. So we do that cost, add it to our other payroll costs, get a total payroll cost, and we're going to use that number. That's going to be entered on the forgiveness form, total payroll cost. Okay. In terms of FTEs, same thing. Each employee who makes over $100,000, their FTEs are also added to the forgiveness form. There's a place where total FTEs is entered onto the forgiveness form. Don't forget to include people who made over $100,000. Finally, we can complete our calculation and fill out our application. To prepare and submit we need to prepare and submit the following pages of the PPP Loan Forgiveness application, readily available through any Google search. It's a 3503 form or something like that. You'll know it when you see it. You actually start at the end and go back to the beginning. So that PPP Schedule A, page 6, will typically be filled in first, then page 3, and then you review the representations and certifications, and that is the essence of your PPP loan forgiveness application. The calculation itself at this point becomes relatively straightforward now that we've used our spreadsheets and done all the work. We're going to add payroll cost to the business mortgage interest payments, the business rent and lease payments, the business utility payments, and subtract that salary hourly wage reduction amount that we came up with, the 1 or 2 people, hopefully, or no people that didn't get their salary or rate returned to previous levels. Okay, so we're taking that total dollar amount and we're going to multiply by the FTE reduction quotient. And that will be what we call the modified total of the total cost mentioned a couple of lines above. We're going to take payroll cost, just that component, and multiply it by 1.667, and we're going to call this the payroll cost requirement. And we're going to compare modified total, payroll cost requirement, PPP loan amount. We're going to compare those 3 numbers. The smallest of these numbers is your PPP loan forgiveness amount. So in other words, if that 1.667, the inverse of that number is 0.6, that's the new threshold for labor cost. If your payroll cost requirement number is greater than your PPP loan amount, that's good. If your modified total is greater than your PPP loan amount, that's good. That means both of those things mean you have 100% loan forgiveness. Okay. I'm going to talk about all the reports and such that we need to gather.
There are quite a few. Summary of data collection needs. Invoices, copies of cleared checks and or bank statements that demonstrate your non-payroll costs during the cover period. So that's what you'll need for the non-payroll costs. For the payroll costs, FTE calculations and salary wage rate calculations, you will need payroll reports that show wage and other payroll costs plus paid hours by employee, that is by employee, for each of the following periods. See, there are quite a few. Your coverage period or alternate payroll coverage period. February 15th through June 30, 2019. January 1, 2020 through February 29, 2020. The pay period that includes February 15, 2020. February 15, 2020 through April 26, 2020. Pay period that includes December 31, 2020, or maybe June 30, 2020, where I think we've talked about that. Additional guidance may be coming. Reports that show salary rates for each pay period in 2019. And the interesting about that is that, we know ASCs, quite often they have quarterly bonuses or even annual bonuses. And it's important to look at each of these pay periods to see if any one particular pay period was inflated because of a bonus that pushed someone above that $100,000 annual threshold. And that's also to determine, okay, what was that bonus? What period was it covering? Was it a quarterly? Was it an annual? And then once you determine that, there could be an adjustment you could make that would get that person back to where, on a per pay period basis, they are less than $100,000.
Yeah. So, thanks, Dave. Just a reminder, or to recall, that last bullet point is for that decision whether you're including a person in the pay rate reduction analysis or not, right? So you're really just looking for those people on your payrolls, on your census, that are close to the $100,000 level. And then regarding that bonus situation, yes, if it's a quarterly bonus, then divide that by the number of pay periods in that quarter. If there's a $500 bonus over 6 pay periods, well, then it's 1/6 of $500 that may need to be added to the wage paid during that pay period. And if that total puts them close to a $100,000 pay rate, then you need to look closely at it. So what we're getting at here is really you can narrow it down to just a few people you're really analyzing for this purpose. It's kind of sifting either in this bucket or that bucket, and then there's a few you really just need to take a close look at, and that's the reason for that last bullet point.
Bottom line is there's quite a few things we need to look at. A lot of reports to run. In addition, need to have a payroll report that includes wages and hours for the first quarter of 2020. You may now, the other thing that is worth noting, you may not have access to the tax forms for staffing agency employees. Payroll reports from staffing agencies are considered equivalent third-party payroll service provider reports.
That's right in the form. So as with the application originally, those reports are valid. Other questions? Eligible wages do not include payments made to independent contractors. So do not include independent contractors in your analysis here. Eligible wages may include payments made to temporary employees, however. So a temp agency that provided a staff person to you, so long as you can include those folks in all the analysis. If you're going to include them in the coverage period, make sure you also include them in the comparison period. However, I mean that is those employees that would have been there then. So long as those employees were not included in the temp staffing agencies, that firm's own PPP Loan and Forgiveness. It's a pretty quick question probably to them if you want to get into applying your temp staff to this analysis. Clarification on paid versus incurred. We spoke about this briefly at the beginning of the presentation. So borrowers are generally able for forgiveness for the payroll cost paid, generally eligible, excuse me, borrowers are generally eligible for forgiveness for the payroll costs paid and payroll costs incurred during the 8-week coverage period, or 24-week if you choose that one. So again, you may, let's say the 8-week covered period. Typically you'd think that's 4 pay periods, 4 biweekly pay periods. However, you may have a fifth that you can include, a fifth check run that you might be able to include in your cost. And that's good. That's giving you more payroll cost for the purpose of hitting the 60% threshold. Payroll costs are considered paid on the day that paychecks are distributed or the surgery center originates the ACH credit transaction to the firm or agency paying the wages. That's the date of paid, called quote-unquote paid. Payroll costs are considered incurred on the day that the employee's pay is earned. Payroll costs incurred but not paid during the ASC's last pay period of the 8-week or 24-week covered period are eligible for forgiveness if paid on or before the next regular payroll date. Otherwise, payroll costs must be paid during the 8-week or 24-week coverage period. However, some creative accountants or attorneys, there's bullets in there for them, count payroll costs that were both paid and incurred only once. All right. Okay, so that is our presentation. Right now, we are not showing any additional questions. I don't think. Let me make sure of that. Oh, here's a question. If you choose the 24-week period, do you have to maintain your FTE level the entire 24 weeks to receive 100% loan forgiveness? So I'll take a shot at this, Dave, and if you need to correct anything I'm saying, please jump in. So in your 24-week coverage period, you will realize an actual FTE per person. And you're going to compare that FTE per person to your reference period, the first 2 months of 2020, right? Or that period in 2019. You're going to make that comparison. So that's the starting point. And so I think what maybe this question is referring to is the safe harbor. The safe harbor being December 31st, let's say. And the answer is no. You just need to have them at that level on December 31st. That's what the safe harbor is. So great question. Thank you for that. Any other questions? We're open to attempting to answer. And don't see any quite yet. Oh, here we go. How will employee benefits be accounted for? Another great question. So that is part, we kind of breezed by that, but that is a part of the payroll cost. And so the allowed amounts to be included in payroll cost are company share of medical, dental, and vision, flexible spending account, or HSA, let's say. I apologize, not HSA, but HRA. If you have an HRA that the company puts money into, that's included in payroll cost. And then any employer match on, let's say, a 401k plan, the match component, not the employee part, but the company match component. Paid and or incurred, right, in the coverage period, right. So I hope that answered that question. Dave's nodding yes. Okay, one more here. Our company usually pays a percentage of health insurance, but for the month of April, we picked up the whole amount. Will there be an issue? I'm pretty certain that the company paid the whole amount within the covered period. Then that is all included in the payroll cost. Good question. Because otherwise it would have been included, let's say the employee deduction amount would have been included anyway because it's really part of gross wage. So. Best forecast when final rules will be issued? Question mark. Before June 30th? Well, we hope so. You know, and to give credit where credit's due, the past cycles, the guidance did come out pretty quickly after the laws were enacted. So we're expecting them very soon, but we don't know for certain. Okay. Well, not seeing any other questions come in. Again, we thank you very much for joining us on the call today. And look forward to next time. If there's enough clarification or enough items or enough new information in this next clarification or guidance set of guidance issued, we'll certainly do this again. So we hope everybody joins us at that time. Thanks so much.